what used to be a Series B round became a Series A round. What used to be Series A became a seed. We are, of course, in the midst of an early part of a massive AI-led shift. The tech world generally seems to be going almost like a recession from an employment perspective. You have to do multiple things. So just doing a ChatGPT wrapper or GenAI wrapper, that's not interesting enough from a venture scale perspective. If as a startup, you're really laser focused on one workflow, maybe one vertical, one horizontal, and going really deep and building the best product, then you have a shot. A lot of these so-called wrapper startups are going to fail or going to get just obliviated. Maybe we don't have resources to build this right now, or it'll take too long. It's going to take us 2 or 3 years if we start now. Not all acquisitions are successful eventually. Constantly is, if you're building purely for the US market, your success rate is going to be likely a lot higher. Every enterprise customer that you sign up in India arguably is reducing your likelihood of getting to PMF. Sometimes the gravity is, hey, let me hire someone like that. Let me hire these people now from tier 1 brands who have scaled up other things. Let me just say, see if they can just scale this playbook. That doesn't work well either most of the time, because that product market fit just doesn't hold. I mean, if you do get enterprise customers, that can often be one of the fastest ways to scale.
Building in stealth is different from just building in isolation. Do you really feel that there is an opportunity for the early stage folks to take on the big guys who have all of the resources? Anupam, welcome to the Desi VC podcast. Absolute pleasure to host you here on the show today. How are you doing?
Thank you. It's great to be here. Beautiful sunny day outside. Thanks for having me.
Well, I've been thinking about how to kick off this episode ever since we started having this conversation of making this happen. And for somebody who spent about 2 decades investing, I wanted to ask, when you were getting started off in your career, did you kind of think that eventually you'd be spending your time investing in tech founders as opposed to building something yourself when you were early in your career?
Yeah, let me just give a very quick rundown of my background. So started off as an engineer, grew up in India, went to IIT Delhi, studied computer science, came over to the US almost 25 years back, and actually started on the operating side, building things, initially in a larger company, and then in a couple of startups in product and go-to-market roles. So I really enjoyed the startup journey, really liked what I was doing, and I wanted to start a company, and I worked on that as well. But there were a few different steps that took me towards venture capital. So I, at the time, I was spending some time at MIT 20 years back, helping a professor commercialize research, and in the process met some VCs. And before that, I didn't know what a VC was, but I found it really fascinating that someone's whole role was to just work with startups and listen to pitches, talk to really smart people, and then be able to be in a position where they could go and help multiple startups at a time. So really like that concept. I thought VC was a way to go work with 5 startups at a time instead of 1. So with that idea, about 15 years back, entered venture capital. But to answer your question, when I was growing up, I had no idea what a VC was. So I didn't think I would be a VC because I didn't know what it was. But then I did work for several years towards that goal, going through a couple of school degrees and doing free work for a few different VCs, networking into the space, and then finally broke in 2009.
Yeah, we were discussing this before the recording as well. The markets have changed so much. The ecosystem at large has evolved over the course of the last 2 decades. So if I were just do a little walk down memory lane, you've spent a lot of your time investing in SaaS companies. How have you seen the industry evolve over the course of the last 20 years?
Yeah, many things that have changed and many things that are similar. I'd say some of them are pretty straightforward, so I'll go through those quickly. Of course, the magnitude of the ecosystem is probably a couple of orders of magnitude higher than what it was back in the day, 15, 20 years back. Everyone knew each other. The industry was so small, even in the valley or certainly so in other areas.
Right.
The round sizes were very different. So what used to be a Series B round became a Series A round. What used to be a Series A became a seed. Now it almost feels like they're shifted by 2. So some of the larger seed rounds we are seeing these days are what used to be actually a Series B round 15 years back when I started in venture. I'd say venture overall has institutionalized a lot more. It has also stratified. So back in the day, there used to be a few venture firms that used to do, they were early stage venture firms. But now you have, of course, many different types of firms. You have these large multi-stage firms, which are maybe 10x, 20x larger fund sizes than what they used to be. And now you have a lot of smaller specialist firms which are coming in at different stages earlier on, and the early stage has then as a result has a lot more options for entrepreneurs. Then, of course, there've been many cycles of technology shifts, and we are, of course, in the midst of what I would say is the early part of a massive AI-led shift in the way work is done, how we live, how we operate, how we do anything. And the shift is potentially bigger than any that I have seen in my career, and I would argue that most have seen in their careers. And so super excited about that. A lot of opportunity, a lot of things to solve, a lot of problems that come with that as well. But I'd say all of this will redefine venture once again as well with how things are done.
One of the hardest things to do as an investor is look back, in retrospect and say the class of founders during a particular period was perhaps better or worse than what it is today or during a particular period of time. So let's assume the periods between 2011 to 2014 versus 2021 to 2024. Is that even a fair, accurate assessment of comparing two different eras of founders, even though they're just about 10 years apart, and say that the founders today perhaps a little bit more smarter, better, faster, or are they not actually smarter, better, faster than the ones that came before them? Like, how do you look at it when you're making investments? But more importantly, just evaluating at large if the industry is really evolved from a build perspective.
Yeah, interesting question. So I'd say there's a couple of different dimensions on which there is change in the nature of founders. So one would be that sometime around between 2010 and 15, content and information about venture and startups started to become a lot more mainstream, including blogs initially, a lot of stuff out there on Twitter, and then podcasts and other things like this, books and other things. Before that, it was actually very esoteric, and you had to actually talk to people to get a lot of this information. So founders had to go through that journey personally, learning every nuts and bolts of building a venture and raising money or hiring people or just scaling ventures. When that happened, when you start to have this content permeate with a lot of depth and a lot of insights, then you would start to tell that, hey, here are some founders who've gone and studied all of this, and they're already at that point where they don't have to learn all of this, and there may be some others who haven't done that. And these founders who had already done that, they're at a big advantage, because now if you can go and learn everything that's out there, you can at least avoid some mistakes, or you're shortening that learning curve that you're going to have. And you've also demonstrated this propensity to learn things that are important to your success. So I'd say that was probably one major shift, and that continues to compound as you have more and more info. Info is just coming faster and faster, especially in the space like AI. The rate of new information that's coming in is just unprecedented, right? It's orders of magnitude more than before. So people that are able to keep up with that and then also goes with that is ability to tune out noise, because there's just more and more noise as well. And there's so much info that one can, so being able to filter down into what matters. I'd say the other piece is with different technology cycles, there's a different crop of, founders that come in, and also with market cycle. And what I mean by that is, when the, let's say the market was really hot and the opportunity cost became high to do a startup, because you could take a job at Facebook or Google and they're paying you, hundreds of thousands of millions of dollars a year. Then there was a certain dynamic of founders. And also now you have this massive dislocation with AI. So what we're seeing in the last year or 18 months, I'd say, is the quality and quantity of founders has really jumped up meaningfully. So and it's probably a combination of the fact that the tech world generally seems to be going almost like a recession from an employment perspective. So it's not like people are getting thrown these offers for big step-ups in their roles and compensation, all of that. And coupled with the fact that everyone's seeing this once-in-a-lifetime opportunity to get into the AI space. So this is probably the highest quality crop of founders that I've ever seen that we are seeing currently. And some of it is just compounding over the years with the founder set growing bigger. If I had to add a third one is also, founders who have seen a journey or two before, either as founders themselves or as early employees or part of a scaling or startup journey. Those generally tend to have, they've seen some of those things, so they have internalized some of those pieces. So as the ecosystem has gotten bigger, there's a lot more of those people now that have seen multiple journeys. So that also compounds the quality of founders. So I'd say, yeah, over time, there's been a trend to founder quality going up. And then I think there's just been a step jump last 18 months with AI.
Yeah, you talked about how quickly these founders have had to learn about the changes that are coming about in the ecosystem. But on the other side, so do you. As an investor, there's so much happening and you can easily get lost in the noise, but also at the same time, keeping up with the pace of evolution with, let's just take with the world of AI. How do you as an investor make sure that you're constantly like learning and keep up to date with everything that's happening around you? Like what are your models and frameworks for keeping up to date with the ecosystem?
Yeah, for sure. I'd say so. There's again more regular cadence, which just as part of this role, there's a significant amount of learning that you're doing continuously. You're meeting founders, and as soon as something looks interesting, model is to just go and dig deep. Whether it is talking to people in the space, reading up things that have been written about it by smart people, talking to others, experts and others in the space. But with again with this dislocation over the last 24 months or more. Uh, that's gone to another level. So I'd say it's a combination of a lot of reading, and that amount of reading has gone up. Talking to a lot of people, that has also gone up. And then again, as we meet founders, if it's a segment that we don't know a lot about, let's say a new industry vertical or a new function area or somewhat new, we don't understand the dynamic fully, then being able to just roll up the sleeves and dive deeper and building as much info as we can on that space. And then all of that compounds because now you're doing that with multiple sort of folks over time. And then last but not least, of course, now with the portfolio of number of founders that I work with, so you get to see through their lens a lot of things happening, and then you're able to sort of you're both consuming and also disseminating things across that set and more.
Yeah.
But yeah, I'd say it's more intense than ever in terms of the amount of info, and then sorting through the noise is really key. So just tuning out some things which are just not important and just focusing on what matters.
I can only imagine because I think I left VC just before the whole AI bubble or the wave that kind of like came about. And even before that, the years of the pandemic were somewhat similar, where things were just happening so quickly. While it was happening across a diverse set of like industries, it wasn't just like one industry that was driving all the revolution. You kind of still felt like you got to keep on top of things. And you could easily get lost with so much that was happening across the globe. And people were doing copycat models from across the world here in the US, which has never been done before. People have always copied what's worked in the US and taken it abroad. But for the first time, we saw a lot of those companies coming here and trying to do something different. But that was not from an enterprise standpoint, more so from maybe a consumer angle or maybe a little bit of like prosumer angle. What I want to talk to you a little bit more about is how you mentioned today you're seeing a crop of founders that have perhaps been better than ever before. The fewer opportunities in terms of the step function changes with employment and titles that's given people more conviction that, hey, maybe this is a time for me to like try and see if I can build something. Now, as you have more people entering the space and wanting to like build maybe in AI, a lot of the companies that we've seen are perhaps rappers to an extent. You're also then looking at people who are trying to like build something that can really change the way the models themselves are, getting out there into the market. And very few companies are doing it because, of course, you need capital, you need people, you need the right amount of resources to get that that step function evolution with just LLMs or even with just the modeling as such. Do you really feel that there is an opportunity for the early stage folks to take on the big guys who have all of the resources to bring about these changes, and they're all going to be building some sort of like wrappers on top of the existing AI models that the big guys are putting out? Or do you really feel that the small folks, by small, I don't mean the guys who have raised $100 million, because that's still good enough capital for you to be doing something different, but people who are perhaps starting off with early pre-seed, seed stages where the capital that they've raised is perhaps $5 to $10 million?
Yeah. I'd say, so there is, of course, generative AI, which, depending on how you define it, is somewhere between 2 and 6 years in. The first transformer-based library started coming out maybe in 2018. Some of our portfolio companies have been using them since then. And then I'd say it really started to hit that moment after ChatGPT came out just over 2 years back. In the enterprise, which is where we are focused on enterprise AI, that's what we've been doing for the last 8 years. And, of course, there is GenAI, but then there's this predictive AI, which is machine learning, deep learning, a lot of data-oriented technologies. That part of the technology is at this productivity stage now, right? It's gone through its hype cycles, up and downs. A lot of investments have happened. Enterprises have created all these data stacks. They have, problems are clearly identified. Hey, these are the things that can be solved. Now you have generative AI, which there's going to be another phase with all of that. So, I think currently what we're seeing is the way to build value, or one of the ways to build value in the enterprise is really you have to do multiple things. So just doing a ChatGPT wrapper or GenAI wrapper is interesting, but that's not interesting enough from a venture scale perspective on its own in our experience. I think in the enterprise, you still have to fit into their workflow. You have to go understand a workflow really deeply. It could be in a vertical, it could be in a horizontal function, and it's a very specific thing. Then you have to, ideally in many cases, you are leveraging predictive AI and the underlying data stack that's been built, and you're putting together some data strategy around that where you have some data modes and specialization. And then GenAI on top of that, which is a great technology for completing the loop. But on its own in the enterprise, in our experience, is still relatively incomplete. Hallucination problems, data limitations, many other issues. So the best companies, the best startups which have raised those few $1 million, which are positioned against the incumbents, are ones which are doing some part of all of this and doing it really well for a specific problem. So you're building, something to automate the workflow. You have potentially a predictive AI, machine learning, deep learning model underlying. And then you have a GenAI wrapper, perhaps, or maybe you're innovating on the model. And the wrapper there's also a continuum within wrappers. So there's one layer of wrappers which just call an API on one side and then give you an answer on the other side. But then we're starting to see more sophisticated things which are combining multiple things and maybe creating an agent, or it may look like a wrapper, but you're doing a lot of different things. And again, in the enterprise space, you have you have all the access control, you have governance, you have the data cleansing issue. You have to figure out more predictability. You have to reduce your false positives, negatives, hallucinations. So all of that takes a lot of work and iteration.
Yeah.
In which case, then it becomes similar to prior set of problems with, hey, incumbents are there. They have a lot of money. They have a lot of very well, smart people. So if they put their mind to it, they could do it. But then, there's this whole law of gravity in software and the world, which keeps people like you and me in business. Otherwise, what would have happened with all these companies which are $1 trillion market cap and billions on the balance sheet? There would be no room for startups. But what happens is, as you and I know, there's an inverse correlation with the size of teams and how fast and in how many directions they can innovate. Right. So I think that comes into play to some extent, where if as a startup you're really laser focused on one workflow, maybe one vertical, one horizontal, and going really deep and building the best product, then you have a shot. And you have a shot also at building moats if you have a specific data strategy. So that's the combination we look for. And of course, a lot of these so-called wrapper startups are going to fail or going to get just obliterated by larger folks. But then a lot more new $1 billion ARR plus companies will get built. And my thought process is, the SaaS world created a few dozen of those billion ARR type companies. We'll see hundreds in the application layer alone from the combination of predictive and generative AI over the next 10 years.
Right. Let's take an example. Is character AI perhaps a bad good example of a company that perhaps looked at a particular niche, built, and then got acquired because Google, at which it's the operations which are at scale, perhaps is a better fit from just being a good acquirer for this company? Because going back to the point that you made, you want companies to be thinking about one particular sector and understanding that really well and going deep into that space. But at the same time, you want to be thinking about what is an exit scenario here? I don't know if many of the founders are thinking about building vertical companies within GenAI or AI, which can perhaps break out and go IPO. I think the market's too young for that as yet. So is the game always to get acquired right now? Is that how people are thinking about it?
Actually, I don't think so. I think it's hard to build a company with just that goal. There is a playbook around that. I'd say maybe it's a little harder as a VC and also just from a personally what excites me perspective, uh, I'd say what I find much more interesting is if the path is to, you have to combine this long-term vision. You are in a generally interesting zip code. You've started in a great time with a great technology, but you have a very sharp, specific beachhead where you're solving this problem, which is maybe right now a drop in the ocean of the bigger space. But then you have the ambition, and there's a market that lends itself to it, where you can go and tap into adjacent areas as you expand that concentric circle with each sort of stage of the company. And then if along the way someone comes and acquires it, and that happens to be the best outcome for everyone involved, that happens. But it's hard to, I think, engineer for that generally, because I think a lot of M&A, and I've seen many of them in my career now over the years, many of them, the best ones actually are happenstance. Company is doing really well, it's not really cash constraint, and then someone comes along, and usually it's someone that's already in close contact. It's like a partner or distribution or sometimes a competitor who then makes an offer that's hard to refuse. So those are the best M&A. The engineered M&As are relatively hard. Those are done as well, but those are not, you're not playing from a position of strength in that case. And it's very hard to tell which company is going to be acquiring at this specific point of time, because, a lot of internal things keep happening in bigger companies, as build versus buy. Do they have the mandate right now to invest? Who are they going to buy out of the 20 other companies? So my thought is always build something that's, has the potential to be a long-term, independent, large business. And then if the circumstances are such that there's an M&A, then that's great. Otherwise, you still have a path to continue building towards.
But is that how you see founders are building today? I asked that question because I've spoken to a few VCs, and they tell me that their portfolio companies, as well as the ones that they've spoken to, are not building with that mentality of wanting to be like super long-term, especially within GenAI.
Yeah, so I think there's all kinds. Obviously, there's both kinds of founders and companies. But I'm just speaking to what kind of companies generally do well across market cycles. Because GenAI is hot today, and there's an acquisition spree going on, and people are staking out their bets. But I don't know if 3 years, 5 years from now, that market is going to be as active, or what those acquirers will be looking for at that time. The companies starting today, would they have that? So I'd say a lot of those are unknowns. So if a company has that as a sole strategy, I'd say it sounds like a more risky strategy to me. Whereas if it had a vision to get to $1 billion ARR, right? And then of course that's also risky. Not very few companies will actually get to $1 billion ARR. But if it's a company that's doing so in a methodical manner, where the business model is working and economics is right and it's growing in the right manner, then the company has options, including acquisition, future funding, getting profitable. All of those are options. But yeah, I mean, for sure, I think is there going to be a lot more M&A over the next 24 months, for sure, as people are specking out different bets. And there are, many more companies with, let's say, $10 billion on the balance sheet. There's 10x more companies with $10 billion on the balance sheet than there were 10 years back. So all of these are potential acquirers now, right? And there is obviously higher number of unicorns than there ever. There's higher number of public companies than ever, in spite of not many IPOs last few years. Mm-hmm. So all of those, many of those are looking for acquisitions. But yeah, again, in my view, I think it's just hard to build with that as the primary goal.
Is it, what I'm trying to understand is the motivation for some of these companies to do these acquisitions. Is it more that, hey, there's a mandate for us to be AI driven in some aspect of our business because that's where the world is kind of heading towards and our customers want to see that? Or is there actually a use case for them for that acquisition? How are the acquirers thinking about it?
Yeah. I'd say, it's a combination there. Of course, as it happens for the new technology, there are, areas that existing companies, large companies, you're an incumbent in, just pick a space, right? Sales, marketing, HR, operations, customer service. There are new shiny objects. There's a bigger, potentially much bigger TAMs than those companies are at today, which are up for play. And obviously, most of the sophisticated ones, they would look at a build by partner type comparison. And if there are areas where they, some areas they'll say, this is just really core, or we're already doing this, and we think we can do this, they will go and build. That will generally be the primary mode for a lot of companies, especially if they're tech first. But then there are other areas where they may feel that, hey, look, maybe we don't have resources to build this right now, or it'll take too long. It's going to take us 2 or 3 years if we start now. And this is important that we have to jump on it right now. Or maybe it's just that we don't have a team that can do this right now. So if we just buy this company, it'll give us both a product and a business and a team, which can just go and run in this direction. Let's say there's multiple reasons, and we talk to a lot of these folks. So there's all kinds of different rationales, and some of them are pretty well thought out. Some others are more just FOMO. But I'd say there's probably more well thought out rationale than pathways. And the most obvious way they would think of, how they're thinking of monetizing these, and those make a lot of sense, is they have often these companies have distribution, whether it's through sales and marketing, if they're sales led, or through just a large installed base of users that they already have. And they spend a lot of time really trying to figure out what's going to be sort of that cross-sell, upsell, attach rate of, hey, can we take this product of this new startup, and if 10% of our customers, 20% of our customers buy it in a couple of years, what does that look like in terms of, how hard is it to sell? Is it ready for that? Are the customers ready for this? How will the sales motion look like? How are we going to change the sales quotas and all of that? So they go through all of that motion to determine whether this acquisition would make sense, and you'll just for risk and come with some price for it. And do that. So I'd say generally they're pretty thoughtful about it, is what I've seen. Of course, as well known, not all acquisitions are successful eventually. In fact, there's data out there that majority are not successful. But then I'd say there's also enough playbooks now in place. The whole acquisition playbook has been around for long enough, and there are organizations which have done a really good job doing those over and over. So I'd say we'll see a lot more of M&A, and a lot of very thoughtful M&A, which will do well over time for acquirers.
Yeah, you talked about some examples, or you talked about companies who have done a good job. Can you share some examples of companies who have done a good job with acquiring a company in the AI space that's then probably boosted some part of their business?
Yeah, I'd say the AI space obviously is new, so it's hard to, we'll only know in 5 and 10 years who's doing the best AI acquisitions. But, the traditional one in the enterprise space, which has traditional, but over the last 10 to 20 years, the company that's done a remarkable job is, Cisco is one. And, Google has done a fairly good job. They've had some misses, but then they have, YouTube and Google Maps and Android, which were really tiny, related to the enterprise value now, a small fraction that they paid at the time. At the time, those looked expensive, and people were wondering, hey, what are they doing getting into YouTube and video? Who watches this free video? Back in 2006, I remember that discussion, and when Android was acquired. So I'd say, Facebook, of course, with Instagram and others. They have WhatsApp. Everyone's wondering 17 billion, 20 billion, but then just look at the enterprise value preservation effect of it, let alone the monetization, which may happen at some point, and the data collection that's probably helped all the AI efforts.
Yeah.
So I'd say the larger companies at the edges have proven, as markets have gotten larger and there's a lot more people that have seen these M&As, how to make them successful, unsuccessful. Many of these companies have done a really good job with these.
Well, hopefully we'll get to see some examples of these within the AI space over the course of the next few years as well. And I want to move to the next segment where we talk about largely some of the investments that you've made, and at large the ecosystems across India and the US that you've been able to see as an investor, and some of the good playbooks that have been derived as a result of some founders who have really cracked the US GTM sitting outside of the United States. So let's talk about that for a little bit of time. There are plenty of founders today sitting out of, let's take India, because probably countries that we understand better outside of the United States, who are building from day one, thinking about selling to the US ecosystem. There are two types of founders who do so. There are ones who have never sold anything. These are first-time founders who are building companies right out of undergrad. And then you have founders who have worked or been operators and building companies for maybe the second time or third time. And these are not founders, but they've been around, and so they at least understand to some degree what it takes to sell to the US ecosystem. What are you seeing today that, one, excites you about the opportunities that are coming outside of the US? I mean, you said you have 1/3 of the portfolio that have at least some presence in India, either that could be from a tech dev shop or a tech backend that's setting out of India that's building for the US ecosystem, or you're perhaps even looking at founders who are thinking about building to the US market from day one. What excites you about this opportunity? And secondly, what are some of the things that you have learned that the new age founders today are perhaps different from the ones that maybe were even 5 to 10 years ago?
Yeah. So we really like this model. So all of our companies and efforts are focused on US and corporate, US market facing companies. But about a third of the founders are in a place like India, the time we invest. And there's another one third which start here, but are leveraging a place like India as a tech hub. So about 2/3 of our companies have a US India model or something similar. And we really like that because, in the end of it, it just gives you a lot more leverage. And there's a cost aspect, of course, which is important. But what's even more interesting is that you get more shots at goal. So if you've raised a, $3-4 million round initially, if you're building entirely in San Francisco versus you're leveraging a tech team in India, you may have multiple shots because product market fit is just, takes iteration. And it takes, if you either get it or you don't get it in the first go. And if you have that runway, it just gives you more shots at goal. So we really like that. And I'd say the whole ecosystem. So when we started Emergent several years back, we have been focused on this enterprise AI and then cross-geography founders focused on the US market. That ecosystem from India to US has grown at least 10x, if not more, in that time period over the last 7-8 years. And the quality has gone up even more. So if I say high quality founders, that number has grown more than 10x. Because now there's a lot of that effect of compounding of the knowledge base of people that have done it and then founders who are now looking up to that or they've already worked in those environments. They've worked for many of those unicorns. There's over actually 30 companies which leverage a US-India model in the enterprise and enterprise AI space, which are US-centric, US-incorporated companies with India tech hubs. So many of these have worked for those companies. They've seen their growth. They've been early employees at those, some of them that. So I'd say that playbook, quote unquote, has become more well understood. Some things that stay constant, and we see some things which people only learn when they do it, and some things where there's a certain gravity to doing certain things a certain way, and then many people will just do it that way, even if it's not the optimal path. One example I would take is, one thing we see constantly is if you're building purely for the US market, your success rate is going to be likely a lot higher. Your chances of success are a lot higher versus if you're trying to sell into both India and US at the same time, if you're building from India.
Right.
Yet we see a lot of founders who start in India, want to build for the US market, but then they find that, hey, look, I know all these people here and it's a large customer and they're going to pay me 100K. So let me just get a few more customers in India. But our experience is every customer, every enterprise customer that you sign up in India, arguably is reducing your likelihood of getting to PMF as a company.
Why is that?
The reason is, it's a little bit, let me give you an analogy. So it's like you're trying to, you start playing cricket in India and you start to get good at it. You start to win some matches. You start playing at the regional level or state level. And now you say, I want to go play World Series in the US in baseball. It looks like, it's a similar game. It has a bat, it has a ball, there's runs involved, and there's a lot of people watching. So I'm winning all these things. Now let me go apply this and play baseball. Or let's put my team to play baseball, the same team that's playing cricket.
Yeah.
Well, this is a different game. You have to learn, can the same team play it? Yes, but if you're only training for that game, you trained for this game, you became good at it, and you think you are a team that plays a good game. Now you can't go, you're not going to, you have to start at the street level or local high school level, but you won't do that. You'll want to go and play directly at, the World Series championship, and you're going to lose big time because you just haven't trained for that game. So the analogy in, is basically product market fit is that World Series and World Cup. And getting to product market fit here often, and this is again for more enterprise-ish companies, enterprise or upper mid-market, where it's a sales-led motion. It may be a little bit different for developer-centric companies or others where maybe there's more uniformity in customer needs. I'd say for enterprise-ish companies, more often than not, there's a difference in the customer needs and also in the positioning, in the messaging, in the way you lay out your website, in the way people are reaching out to the customers and how they're messaging it. And once you've climbed that tree in India, you feel that now I've already climbed, so I can only go up. No, but you have to come down and you have to relearn all that messaging.
Right.
And that's something that gets lost. Once you've built 30, 40, 50 people in the team, you have 2 layers of management before you know it, you've gotten to a millionaire in India. That just makes it really hard to do the same thing here. You can do it, and there are companies and founders who've done it, but they have to start again. They have to come back down the tree. They have to start learning at the street level, at the high school level, start playing at that level, and then relearn that game. And then it can work. But it's just hard because now you feel like you've reached here, you have 30, 40, 50 people, you built your cost base, you've raised a maybe Series A over there, and it just gets really hard to find PMF here.
Yeah.
Let's say that's something we keep seeing. There's of course now increasing percentage of founders, including many on our portfolio, who are just laser focused on the US market. And that's where we gravitate towards more naturally. Uh, but we still see a lot more very high quality founders who still do that, where they will be trying to sell into both markets simultaneously, and then realize later that, hey, look, that is not such a good strategy to try both.
Yeah, it's horses for courses. And one of the things that I understood while speaking to a few VCs was that it's not just about figuring out or starting from scratch in the US once you figure out the India model. It goes back to the point that you made. You already have 1 or 2 levels of management and people within your team. Now, these people might be used to selling in India, and now they're bringing the same tactics that they tried and perhaps worked in the Indian market to the US market, which again does not work. The same sales strategies don't work. And at that point of time, sometimes it's ego versus trying to like evolve and adapt to a new ecosystem where it requires you to have different skill sets. What worked for you in India may not work for you in the US. The same enterprise customer thinks and behaves differently here in the US. The SMB customer in the US perhaps works in different from the SMB customer in India. So while your $1 million worth of ARR is a good metric to hit, a lot of VCs look at that and say, I don't know if they'll be able to like replicate it here in the US. And perhaps that's probably why they want to see a good mix of some value coming in from India. Sure, great, $500,000, $1 million, but can you like double that, or do you have double of that in the US market? And you can show us that there's a playbook that you have developed, which is not just specific to one region, but also to the US market, which is where perhaps a good chunk of your customer base is lying. So have you also noticed that some of your portfolio companies or at large within the industry, that evolution doesn't just have to come about with the founders, but also with the larger team, that maybe that's a sales team, maybe that's a marketing team, GTM team, that needs to think of the US in a very different way, and perhaps from day one, while they may be selling to an Indian audience, just initially just test out what they have is working or not?
Absolutely, yeah. I think it's a combination of all of those factors. And I think you need a very different skill set to find PMF from the skill set you need to scale after you have PMF. And by PMF, there's many definitions, but I'd say at this baseline early PMF, where you're trying to figure out that whole combination of product, positioning, pricing, what messaging is working, what's the ICP. All of that requires iteration, which requires someone like either a founder or like a founder with the owner mentality who can just go and iterate really quick, which gets really hard once you have those layers. The people that you hired to scale after you have established that playbook are going to be very different people. So you would have generally, if you're doing a good job, you would have hired those kind of people on where you have product market fit. And those people may not be the best, and they're not even, I'd say, incentivized or chartered to or equipped to really do that activity of finding PMF here in the US. So that generally has to be done by the founder themselves, some combination of the founders, there's multiple of them, or someone like that who can go and iterate from scratch on all of the things and be able to, if it takes a different part in the product, be able to have that sort of credibility in the team that, that, hey, look, the product direction has to be changed very quickly in this direction, and messaging has to be changed, and new collateral, and just new pricing. So that's where I think that gap happens. Once you start managing a large team, you are then busy with more management style issues and scaling issues. But now you have to go run this different playbook here. And the people that you hired to do that there, sometimes the gravity is, hey, let me hire someone like that. Let me hire these people now from tier 1 brands who have scaled up other things. Let me just say, see if they can just scale this playbook. That doesn't work well either most of the time, because that product market fit just doesn't port. So that team that you hired for, or that you got in place for cricket, you send them here, or you find more folks like that who can play great cricket. They just can't play the baseball here.
Right. I agree with you on the part where hiring for a position in the US, maybe that could be a VP of sales or a head of sales, while you have a different sales team that's sitting out of India, they also don't get along really well, because then you'll have a little bit of clash of strategies, clash of approach, and the founders at that point of time perhaps are a little bit more confused as to what they should be doing. And I've seen that happen with a couple of our portfolio companies that were trying to expand from India to the US, where they had something played out in India. They hired a VP of sales. It just didn't work out. It was about 60 days in, and quickly they were able to realize that maybe we take a step back and maybe we try and do founder-led sales all over again here in the US. And that's when you see a lot of people actually relocating themselves as founders and then trying to do the sales motion themselves, because just hiring for a salesperson in the US does not traditionally just work right off the bat. you need to have a playbook that you can give a salesperson and be like, this is what we figured out. These are the insights. Now you accelerate from here on to like the next level.
Absolutely, 100%. Let's say, the folks that you would look for as a sales hire, whether at a VP level or even a, AE type level or a director of sales level, uh, are very different from what is required for getting to PMF.
Yeah.
So those people are, again, they may be able to do it. Some of them may be able to do it, but their past success is not a predictor at all of what they can do. So generally, and again, that's one of the pitfalls, the mistakes I see folks make is that they'll be prioritizing for, hey, they were at this big brand name company in their space, and they scaled it from, they were there from 10 to 100 million ARR. So they've seen all kinds of scale, and they have this Rolodex. So I'll just put them in, and I'll take this, million ARR they have in India, that I have in India, and they can just go sell the hell out of this and take me to 10 million in the US from there. It just doesn't work that way because, it's just a different skill set. When you're working as a salesperson for, let's say, a big brand, which already has a playbook in place. Yeah. It has very specific territories. It has very specific collateral. It's very well known with customers. It's not easy to close sales even with that. But the skill set, the muscle you need to succeed in that is extremely different from the muscle you need to actually start winning the first 5 or 10 customers. And that's the muscle which generally, that's the founder is the person that should be developing that muscle. So I'd say that's exactly what we have seen in our portfolio is once a founder moves over to the US, if they started in India, or once they start spending meaningful time, the compounding that starts happening is just different. It's a different level. When they are in India, it's just, things are just tough because they're trying to hire people, they're trying to hire someone to solve this, or they're trying to visit. But once they come here, the quality of people you can hire over time, that also certainly jumps because, the best salesperson may or may not want to work for a remote founder. Once the founder is here and they see, hey, you have staked it out and saying that this is your most important priority. So there's a virtuous loop there. Then there's a virtuous loop with customers, especially if you're, again, sales-led with enterprise or upper mid-market. Your customers are just generally, everyone is back over the last couple of years. And again, in-person touch points really help drive some of that traction. And then on the investor front also, founders who are here just have a much better time raising financing here and then creating a lot of the other virtuous loops. So absolutely a big fan of that model of, if it is an India to US type company, for the founder to really spend most of their time here, if not move. And the first 5 to 10 enterprise customers or 10 to 20 mid-market customers, you have to really drive it as a founder. And I'd say even not just 5 to 10, but 5 to 10 consistent till you have that PMF, similar ICP, similar messaging. Once you've closed those 5 to 10 customers, then that's when a great salesperson can come in and start replicating that playbook.
Yeah.
But they will not create that playbook for you.
Is the advice to move sooner to the US, especially if you're selling to the US market? And secondly, would you rather advise them to look at mid-market SMB customers first to prove things out rather than going out to the large enterprises because those enterprise customers perhaps may take a longer period of time for you to realize what that partnership could look like? Now, by that, the caveat that I have here is that you're probably building a product that is applicable both to the SMB market as well as the enterprise market. Of course, if you're building for the enterprise market, you go for the enterprise market. But would you rather give them that advice that try and build out your $500,000, $1 million in revenue with your SMB customers before you start engaging the larger folks because it could waste time in some cases. You probably move the product roadmap a little bit to cater to a particular customer, which you have no complete clarity will convert to a full-time customer or not. How do you see the best approach there?
I'd say it's pretty bespoke. So I don't have a specific rule of thumb. We have partnered with companies that have done both. So some companies which are just very large enterprise centric from day zero, and companies that started with that more mid-market and moved upwards. I think it comes down to a few different things. One is, what is your ideal customer for the product you're building? There's some products where a natural, larger enterprise is a natural customer where there's so much complexity that that's who needs a product, and maybe mid-market and smaller don't even need that product.
Right.
All right. And so in those cases, plus I think the second aspect which I think about a lot is deal size versus sales friction. So if you're closing $1 million deal in an enterprise and let's say $100K for a upper mid-market for a similar type of product, and it's maybe 2 times, 3 times the sales friction. That's great, right? Spend 3 times more time, but get $1 million
$1 million check.
versus 100K. But if you are spending 20 times the time or 50 times the time and you're only getting 10x, then it's not worth it.
Right.
And that depends a lot by specific circumstance of that product, by type of some, and also I think some enterprises in some segments are much more tech forward, and in some other segments they're not. So I think you really have to discover that for that specific product that you're building, on whether large enterprise and the ones you're even within segments there are companies where. So you have to really sense that out of, hey, is this a customer that's actually likely to convert, or are they just buying optionality because, hey, maybe I have GenAI or something and they want to learn about the coolest GenAI products. But I mean, if you do get enterprise customers, that can often be one of the fastest ways to scale once you do get them, or even to get product market fit, because you get 3 or 5 enterprises which are, let's say, consistent use case, large deal sizes, and maybe a lot of expansion built in. Some of those companies can really scale very, very quickly. Whereas with mid-market, if I've seen companies where maybe they're doing 25K, 30K deals, and that can get really hard to scale unless you have this endless market. Those deals get very hard to scale after 500K or million. Suddenly, to add the next million at 25K, you need 40 customers. And now to go from 1 to 10, you need 400 customers. And your friction is as if, they'll also, for them, 25K, they may take 3 months, 4 months, 5 months to buy those. So you might be better off selling 250K deals and spending 6 months doing that. So I think it's very bespoke, and we've seen both those work well, and we've seen both those fail as well.
What are some of the common mistakes that founders do when they're trying to sell to enterprises?
Yeah, I'd say lots of things. And, I think after that first, so there's a phase when you're collecting feedback and figuring out what product to build. And at that time, it's great to cast a wide net and collect feedback. But after that, once you figure out what you want to build and you have some thesis, you have some early beachhead of a PMF, you have to start to get very aggressive on qualification very quickly, customer qualification. So founders will often get very happy that, that customer took my call and spent an hour with me, or they sent me a follow-up note, which is great, all good signs. But there are many people, especially in larger organizations, who enjoy, the time with startups, and they get their intellectual stimulation with it. Maybe they have a 2-3 year time frame of product. Maybe they're even looking to change jobs, so that's why they're talking to you. So all kinds of wrong reasons why they're talking to you in many cases. And as a founder, you have to get really good, and as a salesperson as well, you have to get really good at sussing out where the real interest is. So some of it is the usual band type criteria. Hey, do they have the budget? Do they have authority? Do they have need? Do they have timing? Do they have urgency? Are they able to make that decision? Are they the right person I'm talking to? But some of it is just also, you have to develop that intuition on, are these threads actually going to lead to something? And you have to have many more of those threads in the hopper. You can't just rely on, hey, I have this 2 or 3 things, and then you're just thinking that, it's going to close. Those close rates are really low. You just look at the statistics, you'll maybe from qualified opportunity to closing is like a 10-15% is a good rate. So to just close one deal, you need 10 of them in the hopper. And to close 5 or 10, you need 5 or 10 times that. So I'd say those are a couple of places where, and some of it is just natural human tendency, because in a lot of other things we're doing, it feels like you don't have to have as many conversations. I'd say a few other things that we see often. I'd say we see underpricing very often of products. And again, to get traction or to get quick sort of logos, founders will say, okay, let's just, they'll just put some price. And they don't, general tendency is not to put too much thought into pricing, which is fine in the early days. But at some point, again, very quickly after that, you have to get somewhat sophisticated on pricing and make sure you're able to get enough from each customer. Otherwise, again, you start to hit a wall after some time. Once you get to 500K, a million, if you're doing a lot of these 50 to 100K deals with enterprises, that'll get really hard to scale. You have to find a way to scale those deals to a much larger number and have those vectors in place when you first sell them. Otherwise, if it's an enterprise-wide rollout and it's 50K, 100K, there's just not that many enterprises in the world to build a very large business, right? And they take a long time to, 50K product will put you through all the procurement, on all the InfoSec and all the community reviews and all of that. So you might as well, 50K is fine as a beachhead, but is it for is it clearly identified? Is there some consumption element or some outcome element or some other element where you're saying that, okay, this is 50K for this scope. And then once you have these other things or other departments or other consumption across other parts of the code or whatever it is, this is how we scale those. So I'd say Often folks would think about that a little bit later, and can we fix at that time? But it gets a little bit harder once you have already sold some of these deals, and then customers talk to each other, and precedent has been set. It gets hard to suddenly increase it by 10x. You can maybe increase it by now linearly.
Yeah.
So we see that pretty often, especially I'd say founders coming from India. Often, if they haven't sort of lived and sold here, they'll think that hey, if I give a lower price. Interestingly, enterprises are very interesting. Of course, they're price sensitive, but compared to what people think an enterprise would pay, generally they're willing to pay a lot more, and that's not the constraint to not buying. So for a large enterprise, 500K is not a big number. Often, or even let alone 100K, 500K is not a big number. Often, what's the constraint to buying is who is going to be actually deploying this? Do I have the resources to do this? And will I actually see value from this? If I deployed this and I don't see value, then I'm going to face the music from others that, hey, you spent 500K on this. So that's when it becomes bad. But if it's a 500K investment and you're getting a clear ROI to 5x, 10x of that, enterprise have that appetite and ability to invest. So I'd say don't make the 500K, 100K to try and get the deal. Sell it for 500K, but figure out how those other things can be, other reservations or concerns can be assuaged. That, hey, how do we adopt this? How do we see value? Give them the case studies, examples, or have a team right there in the beginning if you don't have those yet. Have a team in place. It's okay to do some services or some non-linear things in the beginning for the first 3-5 customers. So I'd say focus on that versus giving a very low price in the beginning. That's one advice I often give to founders.
Yeah, it's very important to make the stakeholder look good internally.
Yeah,
in my experience, and we're going through something similar with one of our customers as well, where they don't have the resources internally, and that's a clear-cut message that came from their side saying, "Hey, we don't really know which team is going to get out. We don't know the kind of which PMs are going to be working on this, and we may actually end up having to hire for that particular. If we do end up going with your product, we'll probably need to hire a couple of PMs and 1 or 2 engineers to just deploy on this." And that's where we were getting creative about, okay, can we offer them our resource for about 6 months before they get somebody on board? Can we lock them onto a particular pricing right now, as opposed to saying, hey, the pricing is going to change, obviously, but this is the first year of business, so we'll give you an earlier pricing. Can you get creative around that, lock them in, and then say, well, this pricing will kick in once you obviously start deploying. So you're locked in for 6 months, but then the 12-month period only kicks in once you start actually deploying the product. Or are there other creative ways that you can really make sure that you at least get something off the ground with them, as opposed to just waiting on this, now we don't know when they're going to hire. And you don't really have an internal insight into whether they actually have budgets put into place to hire the kind of people that need to scale this. But if you at least have something in motion, you're at least making sure that, 1, you're top of mind, and 2, because you're in a services agreement with them, the ball's moving on their side it might be moving at a slow pace, but it's still moving to a certain degree, as opposed to you just trying to re-engage after 1 quarter. In which case, you might still be at the same position saying, oh, we still haven't hired for this person.
Absolutely. And, just everyone is short on people right now, right?
Yeah.
Just across the board. That's what it seems like. And so you have to find ways to sort of, manage that part of the reservation versus sort of the pricing discounts or some other things, and make it easier for them to adopt it. Give them that path that, hey, more clarity on you will get value, and this is how it will get adopted. This is who's going to run it, and help them figure those pieces out.
Yeah, I completely agree with you. And I think one more thing that I wanted to ask you about is, what are some things that you've seen some of your portfolio companies do really well right off the bat as soon as they move to the US?
Yeah. Let's say, and we have, again, about a third of the companies are such that, they were founders in India at the time. And the ones that have done really well, let's say they're really good at, and this is true of generally of, one characteristic we look for in founders that we want to partner with, is the ability to just learn and grow themselves. So each day they are, X+1, what they were yesterday, they've added more things to their arsenal from yesterday. And that requirement goes up even further when you are coming in, let's say, from a place like India to the US. And some of them may not even, some may have maybe done some business here, lived here for some time before. Some others may have never visited the country before. So you're going to a new place. So that ability to learn is really critical. One interesting sort of more of a, hack or tactical is you have to find those first 5 to 10 believers. And these are not necessarily just customers, of course, customers, but these could be, advisors. These are people in the ecosystem. These could be other founders that you're hanging out with. So you have to find those first 5 or 10 believers and support system.
Advocates
that you have to build. where you're hanging out with them, and then your network grows from there. So we play that role as well, and then you surround yourselves with whether through your investors or others. Find those, and you have to talk to obviously many more times that to find those 5 to 10 who are going to be real good supporters and advocates who are opening doors for you, or being sounding boards for you, or being mentors, guides in different types of environments, not just as customers, but maybe helping you, and someone's helping you hire, someone's helping you figure out, just basic logistics of settling down in the Bay Area. So some friends, someone you can bounce off, maybe some founders who are maybe a stage or two ahead of you who can talk to sort of their journey. So I'd say that becomes quite important. So founders who have been able to do that, surround themselves with a good ecosystem early on, then they sort of settle down really quickly, and then then they're able to compound their network and presence a lot faster. And of course, I mean, the next one is also always true, is just the right first few hires becomes super critical. And in those cases, with India to US, those will typically be on the sales and marketing side in most cases for those companies. Maybe sometimes tech or AI talent, but mostly on the GTM side. So those first couple of hires become really, really critical, because it's sort of a make or break that also impacts your own sort of momentum if you make a couple of mishires in the beginning, versus if you have a couple of folks that really work out in the beginning, and you start to see the cylinders fire on sales and marketing. And that obviously has to happen a little bit. It's layered on with that activity of finding PMF. So that shouldn't be the day zero thing that, hey, I'm going to hire VP of sales, VP of marketing as soon as I land there. I think first course of action is to try and really figure out whether you have that early PMF or not. But once you have that, hiring those first couple of leaders here, that can really change the trajectory dramatically when you bring in the right person.
Yeah, I agree with you. You're talking about how founders need to build their immediate network, and VCs obviously play that role. It also really comes down to, in my opinion, how the founders are able to leverage their investor network or their advisor network extremely well. I'll give you a quick example. We don't come from, me and my, we're co-founding team of 3. Me and Kabir don't come from the security industry, Neil does. But for us to actually have gotten, one understanding of the security industry and also build our network, we had to ramp up that learning very, very, very quickly. And also at the same time, we only raised from security-focused investors for a specific reason, that, hey, these were the people who will open doors for us. So knowing which investors to also work with, and then building your advisory network, and then being ready to understand how best you can leverage them. For example, we have a few advisors and angels within our network who we know can open the SMB doors for us. So we actually, when we were bring them on board, we looked at it and said, let's do our portfolio construction for our just the investors, and say, here's going to be where the SMB angels are going to come from, mid-market enterprises. And those are the people that we will unlock over the course of, when the product becomes a little bit more mature. And that's what we've done. And then doing the simple things right, knowing which customers to go after, what the messaging should be, having those forwardable emails almost ready, and then reaching out to them and saying, hey, these are the 10 people. Who of the 10 would you be able to make introductions to? And they would be like, these 4. And then instead of them saying, send me an email, I'd be like, I already have emails ready. Just once I give you a thumbs up, just send it across. These are simple things that most founders wait for getting a response and then go back to the drawing board and then come back, and then it's just a lot of back and forth. But if you're able to make that process super efficient, you're able to leverage your network really well, quickly, smartly. And even the ones who are helping you out feel like they're actually working with smart set of founders who they want to continue helping over the course of the engagement, as opposed to saying, oh, they're just a portfolio company of mine, I put in 10K. Because for a lot of these people, 10K is not a lot of money. They're okay losing it. And then most angels anyway write off their investments. But they also want to work with people who make them look good in front of the people that they're introducing them to. And they at least know that they can vouch for the founders who are doing it. I think that's really important for a lot of founders to do, is how best can you not just make the stakeholder that you're selling to look good internally, but also your investors, your angels, your advisors, all the people around you look better in front of their own network. And I think that's really important for founders to think about.
For sure, yeah, I agree completely. I think a lot of these small things which are now well known, but it's surprising that many people actually don't do those. And just by doing those things right, that can give you a significant leg up. Especially again, if you're transitioning from India to US, it becomes even more critical to really leverage, or in all cases actually, just leverage your network that you have. And I think you talked about the angel investors and advisors, and Bay Area has just an incredible number of people now that have done great things, and then that phase of their careers or temporary or whatever, where they're in that give back type mode where they're happy to help startups, maybe putting in some money, some advisory, or sometimes without any economic interest, they're happy to do it. So when you find those, just really you have to then leverage that network. And very few people are able to, very few founders are actually able to do that well. They just assume that, hey, this person is helpful, so they should be helping me. But the thing is, everyone's busy. There are many things going on. So you have to really get that value out of them. And, to put it in a little bit crass way, but, and you have to keep them excited about the company, send them updates, have calls once in a while, and then follow up. When they say, hey, I can introduce you this, and this, to your point, send them those forwardable emails right after the call, and you'll see the very stark difference versus you send it a week later or you don't do it. You say, oh, that advisor didn't connect me with anyone. Well, the thing is, if you had sent those 5 follow-up emails, they would probably have connected you with a couple of them immediately. Yeah. So that's super critical, is finding out all those people and then just compounding those follow-ups. And that's how you build out that network, because these advisors who connect you to 5 people, take those intros seriously, and then either you have this exponentially growing network or you have a decaying network if you don't follow up enough. But if you're those that are following up, many of our founders, they are they're here for 2-3 years, and they're everyone knows them, they know everyone, and because they played this game really well, where they are able to build genuine relationships with people, because they're just exchanging all these notes and they're following up quickly and they're making life easier for them. But I've also seen the other side where someone getting, hey, I'm getting all these 10 angels and they're going to help me with this, and this. And then a year later, it's like, okay, there's zero interest, intros that came out of those angels, because, maybe part of that is that those people are busy or whatever. But sometimes it's also that maybe the follow-ups didn't happen where they should have happened.
Yeah. You're just one of plenty of angel investments that they made, or you're one of the portfolio companies for a VC. They're not going to think of you unless you're giving them something hopefully in return. And you need to show them that, hey, we may not have the revenue, but we are doing things that are getting towards revenue, or we have the revenue, but it's these are the things that we're doing that's probably going to get us towards the next fundraising benchmarks. You got to keep showing them that there's progress that's being made, and that could be either through updates, that could be either through personal messages, could be through introductions. They just need to get a sense that you guys are being proactive, as opposed to just building in stealth is different from just building in isolation. Yep. It's 2 different things altogether. And I think that's where founders really don't get a good sense of what the clear delineation between the two really mean. You can be in stealth, but you got to be extremely active in stealth mode. You don't build in isolation when you're in stealth.
Yep. You have to use stealth to the advantage, not to disadvantage. There's I'd say, no big secrets out there today. There's very rare. I'd say it's probably well less than 1% of companies that I meet, which I think there's actually some secrets that they should be holding tight. Most of the things that I see, there's 5 other teams doing the same thing. So you're actually better off going out and building stakeholders and people that believe in you and be open about what you're doing, versus trying to keep it too much under the wraps, or not following up because, hey, information is going to flow out or something. I've generally seen that to be a net positive if you're able to just share more, get people excited. You just have to stay top of mind, because like you said, everyone has lots going on. They have hands in multiple sort of different, especially angel investors, advisors, others, they're not, with the VC model is different, so we, especially we do lead investments only, and we would basically have 5 investments a year between 2 partners and relatively few. So we will stay in touch with you even if you don't stay in touch with us. But a lot of others, angels, they're doing lots of other things. They may have a full-time job. They have obviously other responsibilities. So you have to keep them excited for them to have skin in the game. And I've seen both of these play in, all kinds of extremes and everything in the middle of how successful or unsuccessful that has been for folks based on how well they were able to keep them excited.
I agree. No, this has been a fantastic conversation, Anupam. Thank you so much for being on the podcast, sharing all the learnings that you've had, insights from some of your portfolio companies, and what you've seen are best playbooks and things that people can be doing better. So I really had a great time speaking to you, and I hope all the listeners also take something away, especially as they're thinking about building companies and selling to the US.
Great discussion. Thanks a lot for having me.
Pleasure.
Thank you.
Thank you.